Good morning, good afternoon, or happy lunchtime, depending on where you are around the world. So this is the latest in our series of webinars from the Saïd Business School, the University of Oxford, that we are arranging in support of a range of our executive education open programs here. Today, our subject is on private equity. So we have Professor Tim Jenkinson, who will open the box for us on private equity and performance in a few moments' time. I'll just do a little bit of introduction for the next minute or two. So, my name's Steve Brewster. I'm an Associate Director in the Open Programs area of the Executive Education area at Saïd Business School. We run a series of 25 open programs throughout the year. Some of them are general around leadership, and some of them are very subject specific, such as the Impact Investing Program, which we ran last week, the Real Estate Program, which we will run in the summer, and the Private Equity Program, which we'll talk a little bit about today. So the format today is that Professor Tim Jenkinson will give us some insights on performance based on some research which he's been carrying out. Tim is the founding director of the Oxford Private Equity Institute, so very much one of the world leaders in research in this area, so it will be very fresh and hot information. That presentation will probably be about 20-25 minutes or so. After that time, there will be opportunity to ask questions. And the way to ask questions is to type those in using your keyboard. So because we have quite a number of people registered and online, then we do keep the lines muted to keep a clear audio signal. So please type in your questions as you think of them as we go along, and then we'll field those at the end. All right. So to introduce Tim Jenkinson, we will just go to here. So this is the format for today, so we'll spend some time looking at that. Professor Jenkinson is a professor of finance at the Saïd Business School, University of Oxford. He's also the head of the finance faculty at the Saïd Business School. He is the director of the Oxford Private Equity Institute, which means that he has been researching private equity, IPOs, asset management for many years. And he is also very involved still on the corporate and the business side as well. So he is definitely an academic who's got one foot very firmly in the business and industrial world. So there'll be some insights based on the practical nature of management and business as well. I will hand over to Tim. So Tim, thank you very much for your coming in today and your time. The floor is yours for the next 20 minutes or so.
Okay, thanks very much, Steve. And the topic of today is looking inside the box of private equity. And what do I mean by that? I guess that one of the frustrating things about private equity is that it is private, and it's very hard to get information about the investments that are done and the returns that are made by investors. And most of the research that's existed to date has looked at fund level returns. In other words, the returns that the investors achieve by investing in a particular fund of a private equity manager. Might be private equity fund 3 or 4 or things like that. And as we know, private equity funds, they take a long time to work out in terms of they have a formal legal life of 10 years typically, but they often go for much longer than that. And it gives you a sort of aggregated view of the world, which isn't always as interesting and rich as you might want. Now, having said that, it's actually a pretty good way to look at certain things like returns. And there's been a whole series of papers which have looked at returns of private equity funds. And indeed, the one I put there on the screen, Harris, Jenkinson, and Kaplan, is a paper with the title Private Equity Performance, What Do We Know? So it sort of tries to survey some of the results that have been found, and indeed utilizes some really good investor data on the returns that have been been gathered. And so, and the results of that, without just giving you the bottom line for it, is really that we found that private equity outperformed public markets by about 3 to 4 percentage points a year over long periods of time. So, and that really underpins the growth of private equity. A lot of investors these days want to have more private equity in their portfolios because they see it as an alternative to public market equity. It's a different way of owning the same type of assets, and the returns seem better. Now, there's a whole bunch of issues there about risk and about other things, but that is one of the, I think, now quite well-established facts. But the next question that most investors say or ask is, so which fund manager do I choose? And that, of course, is a very critical question and is really about whether you think performance of a particular fund manager will persist over time. And what I'm going to do is explain a little bit about some new research based upon deal level data, which I've been doing with Rainer Brown and Ingo Stopp, and is referenced in this paper here, which all these papers can be downloaded off the internet, which tries to look at performance persistence in a slightly different way. So what do I mean by performance persistence? What I really mean is that how well do the successive, the funds or deals that a general partner, the fund manager, does over time, how does that evolve? And the traditional way of doing that is, again, to look at the fund level, to say how did Fund 1 do relative to Fund 2, or Fund 2 relative to Fund 3. And a typical way of doing that is to look at the relative performance, to put the funds into performance quartiles or terciles, so into the top 25%, the next 25%, or the like, and see how that performance evolves from one fund to the next. Now, what are the issues with that? Well, it leads to really what I call here a very low frequency measure of persistence. If these funds are 10 years long, and they're normally at least 10 years long, and they overlap a bit, so that Fund 2 is started in, say, year 5 or Fund 1, then to work out how well those two successive funds performed, you really need 15 years of data. You need, the 10 years for the first fund, and then, the second fund is raised halfway through the first fund, so you're going to need an extra 5 years to see how that fund works out. And there are obviously some big issues there, because most people can't wait 15 years to find out how good the performance was. I mean, just to put that in context, we'd only now be saying with some measure of accuracy what the performance was of funds raised in the middle of the dot-com boom, and that seems like an awfully long time ago. And so there's issues to do with, unrealized deals where you sort of don't wait until they've all worked their way out. You start sort of using the asset values that the investment managers, the fund managers put on them. You find deals that are split between funds. You find difficulties of actually knowing whether funds were investing at the same time, what I call here imprecise vintage years. And I suppose there's a more fundamental issue, which is that the performance of a general partner, the fund manager, is really about the sequence of deals that they do, not really about the deals that they do in one fund relative to another. If there are 30 deals that are done across those two funds, what you're really interested in is how persistent are the deals that they do. In some ways, the fund is just a legal wrapper. Now, that's good in principle, but the problem is that most of the time you just don't have deal level data. It's hard enough to get fund level data. But we now have that data for a pretty large sample of buyout funds. So the results I'm going to show you are based upon data from 865 buyout funds. And the nice thing about this is it's actually split pretty evenly between the US and Europe, with some funds from elsewhere as well. And that, for those 865 buyout funds, we actually have the returns data for 13,500 portfolio companies. So a very large number. And of those, about just a bit over 8,000 of them are fully realized. In other words, the investors have put their money in and got their money out and moved on. So therefore, we know the outturn returns. And for these deals, we have the cash flows in, how much the investors put in, how much they got out. And for the unrealized deals, we also have the latest asset values. But I'm not actually going to focus today on the unrealized deals, so we won't actually use that data. And we know other things about what deal, what sector they're in, what location they're in, etc. And with this data, we can actually do a lot of different things about different ways of thinking about persistence. And I'm going to talk about a few different ways in which we can do that. Now, just a small point about the data. This is actually derived from investors. It's not derived from the fund managers themselves, the GPs. And importantly, it comes from fund-of-funds managers who asked any fund that came through their door to give them their full track record in a standardized form. But it's not just the funds they invested in, it's all the funds they considered. And one of the really neat things about this data is we have a virtually complete record of all the deals that were done, which is very important when you're thinking about persistence, which is looking at performance over time. So what does the data look like? Well, this is a little picture of what it looks like. What we do is we sequence every deal. From the first, we give them a sequence number of 1, and if they've done by the end of our sample period 200 deals, their 200th deal will have that number. And what this shows is how the data builds up over time. You know, it started, as you can see, in the sort of a few deals in the late 70s, and then most of the deals we start picking up are in the 80s, big, jump in deals in the 90s, and continues through the 2000s. So this is deal level data, and you can see that by, say, the year 2000, we have some GPs who have done more than 200 buyout deals by that time, but many more that are more in the 50 to 100 deals. And we sequence the deals by GP fund family. That's, in a sense, an important technicality. But if we count a fund family as being a series of funds which has the same sort of focus. So if we find a GP has a series of European funds, we'll treat that as a separate sequence than if they have a series of American funds. So we gather this data for this for 13,500 portfolio companies, and we then sequence it by the date at which they did the deal. So what I'm going to do in the remainder of the time is just give you a sense as to what that data shows you about whether the performance of these GPs is persistent over time. In other words, do the GPs that do good deals continue to do good deals? Or is it much more random? The way some people think about this is it's a sort of luck versus skill story. We know that there's a big difference in that some deals do really well and other deals you can lose all your money on. And inevitably, one tends to hear more about the deals that did very well than the ones that didn't do so well. And if it was completely random, then you could say, well, there's not much skill involved. It's just luck as to which deals you manage to draw. Whereas, of course, if one GP or some GPs do persistently better than others, then that's saying that they're skillful and maybe the main people that you should direct your money to in the future. So what I'm going to do is to just tell you a little bit about 3 different ways of doing that, starting from the very traditional through to the completely new. And I'm going to start off with a fund level analysis where we sort of do the old-fashioned way of doing it, but we only focus on realized deals. This is a major advantage of this data because even though if you say, oh, well, I actually care about the difference between fund 1 and 2 and 3, one of the issues is, well, we don't even know what the outcome of those deals, those funds are when you've got deals that haven't been realized yet. And so what we can do is just strip them out and see what happens. Then I'm going to show you a regression approach where we basically take these 8,000 realized deals and we throw it at a regression package and see whether or not there's much evidence that particular GPs have different types of returns. And then I'm going to show you something very new, which has been used a bit more in the mutual fund sector, but never in private equity before, which is to show how deal performance dissipates over time. Okay, so that's the plan. Now, in terms of the first approach, the sort of what we call here cleaned fund transitions, a typical way in which you look at the performance of a fund is to essentially put them into some ranking. It could be quartiles, it could be terciles, in other words, thirds or quarters of the population in terms of their performance. And you then compare the funds by compare the performance of the successive funds. So in this simple graphic, I've said, okay, let's look at the funds that were formed in 1983. We've got ABC Fund 4 and DEF Fund 9, which were formed in that year, let's say. And we've got this XYZ 1 fund in there as well, which was above average. And you then look at their next fund. So that could be in 1987, there was some of these fund managers came out with a new fund. And so, for example, we're here assuming that XYZ Fund 2 comes out. And you then rank the funds in that year as well. And you see whether their performance quartile, in this case, stays the same. And in this case, XYZ Fund 1 and 2 are in the same performance quartile. In other words, they were above average. And that would be a persistent performance. Whereas you could have that funds moved between these performance quartiles. And what we do here, this is a fairly traditional way of doing it, but what we do here is we use what's called public market equivalent returns as the performance measure. What that means in simple language is we compare the performance of the fund relative to public market investments that would have been made at the same time. So since we know the cash flow dates, we can essentially set up a mimicking portfolio where every time you send some money to a private equity fund manager, you invest it in an index like the S&P 500 or the European index or like. And every time the private equity fund sells something, you sell the index. And you can compare the performance relative to public markets in that way. And we think, or I certainly think that that's the most appropriate way to think about performance. So if we do that with our data, and in order to be comparable to previous literature, we actually put into terciles, not quartiles. So we split the sample into thirds. What you can see is if you look at the vintages before 1997, so the sort of earlier years of private equity, you see these are the probabilities of staying in the same tercile. So, for example, the top left column here, the top left cell in this matrix, 47.8, shows you the probability of being in the top quartile with your current fund if your previous fund was in the top tercile, so tercile, not quartile. And so what that tells you is that there's a nearly 50% probability that you would repeat top tercile performance. Now, if it was random, the probability would be 33.33%. So that looks like it's reasonably persistent. And similarly, if you look at the bottom tercile, you see the probability of repeating bottom tercile performance is a rather worrying 50%. So therefore, that says you should steer clear of those funds which were the bottom performers in their past fund, because they've got a 50% probability that they will repeat that disappointing performance. So this was the sort of evidence that other people had found, that there was a reasonable amount of persistence in private equity returns. But what happens when you roll the clock forward and then look at the more recent data that we have as well, since 1998 onwards? And when you do that, the picture looks very different. If you look at that top tercile performance persistence is now at about random levels. 31.9% is as near as down at 33 and a third. It's not very far away. And you can see that many of those figures are pretty close to a third. In other words, it looks essentially like a random distribution in recent years. And that's, if you like, the first indicator we have that something's changed, and that as the asset class has matured and become more competitive, the returns from fund to fund have become more random. Okay, so that's using some elements of the deal level data insofar as we can sort of kick out any deals that haven't actually been realized. So they really are cash on cash returns for investors. But what can we do a little bit more inside the box, looking within the funds themselves? And so what you can do, for example, is to do something, you know, fairly data intensive, which is to take those 8,000 odd deals and realized deals here, and see whether you can find any factors which help explain performance. And in particular, you can look for what you might call a GP factor. In other words, we can put in a variable for each GP and see whether that factor has some statistically significant impact upon returns. So let's say you're that GP that's done 200 deals. We put in the same variable, it's called a dummy variable, a GP factor for each one of those 200 deals, and we see whether that helps to explain whether those 200 deals differ from the other 8,000 deals. Okay, so it's a sort of fairly well-established regression analysis statistical technique. And we can control for lots of other things as well, like the industry they're in, the year the deal was done, the size, etc. So I'm just going to show you a fairly scary-looking chart, but I'm going to explain a bit what's going on. So what we do here is we take the previous, the current deal and work out its performance, which we call its gross PME, the public market equivalent return. And then we regress it on various things like the past deal. So does the performance of the previous deal have any impact upon the current deal? And we see that in the early years, in the first little box there at the top, we see in the early years that the past deal did have a significant impact on the current deal. Whenever you see these stars, it means that they're statistically significant. And the more stars, the better. So that means it's significant at the 1% level. And we control for various other things, which I won't go into here, in terms of trying to account for market movements. For those of you who know about more asset pricing type approaches, these are the small minus big factor and high minus low book to market value. So we're trying to pick up factors which other academics and indeed market participants have found can have an impact upon the performance of equity returns. But then when we look across in the later investment years here since 2001, and we use 2001 because it's roughly equivalent to sort of to having a fund year set in the late 90s, because obviously a fund does its investments over a period of years. So we were trying to split this sample in a broadly similar way, but at the deal level. So these would be the second half of those of the deals done in the second half of those funds, which were formed in '98, for example. And so in that case, we see that there's very little evidence that the past deals had any impact upon the current deals. And we see that on in various ways. We also see down the bottom here, we don't just look at the past deal, but we also just say, is there any real relationship between the deals done by the same GP? And so this is testing the significance of those GP fixed effects I was talking about earlier. And in the earlier years, we found they were significant, that having that variable in for each GP did have an impact, but in the later years they didn't. One other thing I just want to show you here. This is what's called the log of the equity investments. In other words, how large was the deal relative to previous deals? And we do find that in some ways the returns that the private equity manager is getting go down as they increase the size of their deal. Controlling for a lot of other things here, which is an interesting finding. So that's, if you like, the second evidence, that in particular this fact that the GP fixed effects are not significant. That is actually quite telling, I think. The third way we can look at it is to actually see the extent of mean reversion over time. And so how do we do it in other asset classes? Well, we tend to do something like take monthly returns or quarterly returns and see how they evolve over time. For a mutual fund, for example, you take their monthly returns and say, okay, they've done very well in December. Do they do equally well in January, February, March? Or does Q1 returns, how are they relative to Q2, Q3, Q4? Now, we can't do that for private equity because the returns on a quarterly basis are really just a function of how the private equity manager is valuing their portfolios, because they don't have neat returns where they dispose of a company every quarter, for example. But we can look at how well the returns or how the returns evolve over the deal sequence. And so what we do in this last piece of analysis is we put deals into quartiles, and then we track how the subsequent 10 deals by that GP evolved over time. Okay, so if you did a top quartile deal in 2002, we then track how the next 10 deals by that GP that did the top quartile deal evolve over time. And if there is persistence, we should see sort of clear blue water between the returns on those next 10 deals and the returns done by other quartiles, by the GPs in the other quartiles. So let me show you what the picture looks like. And this may not be entirely familiar, so I want to sort of explain how it works. So what happens here is, for each deal, we put it into what's called a formation quartile. So by construction, this shows you in the formation cell here, or the bit on the the cell on the x-axis which says formation, it says if we put the deals into quartiles, what would the average public market equivalent return be for those deals? And we see that that goes between something like 0.2 for the bottom quartile, the dotted line, through to just below 1 for the second quartile, to just below 2 for the third quartile, to just over 5 for the top quartile. So you can see there's a huge disparity of returns if you just put all the deals into their quartiles. Then what we do is we track what happens to those over time. So if you like, this is a visual guide to the extent of mean reversion. And you can see that if you took those GPs, and you track their next deal, n+1, if you like, then you would have seen that the GPs who'd previously done top quartile returns still do very well. They have a PME of about 2.5. In other words, they did about 2.5 times as well as the public markets. And you can then look at how each one of those quartile groups evolve over time. And when I look at that chart, I see that the top quartile performers are pretty visibly top quartile for way over to the sort of 9th or 10th deal after they were sort of classified as a top quartile performer. Whereas it's quite difficult to see what's going on with the other 3 quartiles. That there's, you actually see the bottom quartile performers actually jump above the second quartile. So, they get some redemption. You had bad luck, and so then it sort of reverts back a bit more towards the mean. But most people, when looking at that, would say, yeah, there does seem to be some clear top quartile persistence in the early years of private equity. This is up to 1997. So let me show you what it looks like in the later years, again, when we're looking at the deals that were done after this point. And here, you can see the same sort of formation effect, but then it becomes a lot more random after that. That we see much, you can see a little bit of top quartile persistence, but it's much less apparent than it was in the early years. So in other words, what we see is there seems to be much more randomness and mean reversion in the returns on a deal-by-deal basis in more recent years. The one thing that I see when I look at that chart, though, is there's almost more noticeable bottom quartile persistence now. So that the bottom quartile, the dotted line there, seems more distinct than it did even in the early years, which raises some interesting and difficult questions for the investors as to why people keep supporting bottom quartile managers when they keep repeating their poor performance. So that's just a quick summary of some research which has been trying to look at this issue of performance persistence. I think, thinking about this in a slightly broader context, I think that using deal level data is the next big innovation for private equity research. This is using financial data on cash flows and the like, but I think we will have much better information on how the companies perform over time, what the evolution of their earnings are, their balance sheets, their employment and things like that, and also about the professionals who are involved in those deals. So I think this is the way that research in private equity will go in the future. This is the first, if you like, the first piece of research that's been done in this way, and is focused on performance persistence. And I think that the clear evidence is that there's been a reduction in that performance persistence over time. And in some ways, this is like most other asset classes. You know, it's the famous warning that past performance does not predict the future. Well, that seems to be the case in private equity, just like it is in mutual funds, in hedge funds and the like. And so, you know, it's not altogether surprising, but until recently, people still believe that private equity performance was persistent over time by GP. One final taste to leave you with is that some research, some other research, which I'm not going to talk about today, actually does something similar, at least at the fund level for VC. We haven't got good deal level data for venture capital yet. And the evidence seems to be there that it's much less, there's been much less mean reversion, that good venture capital managers seem to repeat their performance. But as I say, that's for another day. So thanks very much for listening to this summary of this research, and I'll be very happy to take some questions at this stage.
Great. Thank you very much, Tim. It's fascinating. So we do have some questions starting to come in. We'll remind people to say if you do have questions on any of the data, the way in which it's been collected, used, or interpreted, then please do ask those now, and you can key those directly into the question dialog box, which hopefully you can see on your screen, probably over to the right-hand side. So Tim, while we're waiting for a couple more of those questions to come in, I asked the first question, which was, there seems to have been a big shift after round about 1998, 2000. Can you tell us what was happening around about that time to cause that?
I think it's, I wouldn't put too much emphasis on any particular date as being the pivotal moment in private equity. I think it's more that the sector has grown and it's become more competitive. And the things that people were doing which were innovative in the late 90s are now absolutely common and a standard way of doing things. So, you know, it was very unusual to use leverage loans in the late 90s, and the innovators there for some years were doing things that people didn't realize you could do. But now financing of these deals is pretty standard, and you can get, banks will compete for the deal. They'll provide pretty similar deals. The structures are all pretty much identical. So, you know, I think that skills get assimilated and competition comes in that erodes returns and makes things more random. And it's also the case that everybody used to talk about proprietary deals, that, you know, I had good relationships with somebody, so therefore they'd give me the deal. But these days in private equity, there are very few proprietary deals. And that's why it's not really like in venture capital, where I think people choose managers because they have a reputation for doing particular types of deals. So you might be, you know, a leader in, I don't know, mobile internet or cybersecurity, and people want to take money from people who are experts in that area. But in the buyout space, I don't think there's really very strong brands that you don't you don't really mind where you take the money from. You just want to get the best valuation, the best terms of the deal, and that tends to lead to a commoditization, and that tends to lead to randomness in returns.
Okay, excellent. Thank you. Do you have some additional questions as well? So perhaps if we take a couple of the ones really around a little bit about the terminology that you use that perhaps is different in different areas. So the first question is, how would we define the vintage year in this case?
Well, in this case, in the case of deal level returns, it's incredibly simple. It is when the money was invested. And that's one of the advantages of using deal level data, because with fund level data, it's very complicated to define the vintage year and other funds. So the typical ways of doing it are the first closing of the fund, the first fund investment, or whatever. But that leads to a lot of arbitrariness about it. If you do your first deal in December, 1997, you might have a completely different, be able to present your performance in a completely different way than if you did it on January, 1998. And so we don't have any of those problems. We just use the date that the money was invested, and that's our vintage year for deal level.
Okay, thank you. And you talked about realised deals as well. How would you define those in this case? Just deals that have been entered and exited as well?
Yes, we classify things in three ways. We have unrealised, we have partly realised. You put the money in, you've got some money out, because you still own the company, part of it, and fully realised, you put the money, you've got all your money and don't own the company. And so the evidence that I've shown you is for fully realised deals, where they are no longer.
So we have a question related to that from Alejandro Navarro, who has asked, how reliable then is the not realised NAV valuations of fund managers?
Well, that's a very interesting question, and again, something that we could have a whole webinar on. The answer to the question, I think, is not drawing upon this research so much as other research which has been done. There's 2 or 3 academic papers which have looked at this, is that there tends to be, there's a tendency towards underestimating the market value of the investments. In other words, that when the investments are ultimately realised, what tends to happen is the amount that's realised tends to be more than the net asset value that's there in the books at the time. Now, that's only one way to think about it. It is actually quite a deep question. So, for example, should the GPs, the fund managers, actually try to form an estimate of the net present value of the future cash flows? Should they be doing should their NAVs be an estimate of their NPVs of the future cash flows associated with those assets? Arguably, they should, because that's what you're trying to do. So there is some research which is looking at this as well, and finds, of course, it depends upon what discount rate you use for your net present value calculation, but that if you use the sort of returns that we've seen in the past, like a 10 or 11% IRR for that calculation, you do tend to find that on average the asset values are pretty good indicators of future net present value of the cash flow. So I think that I think lots of people want to think that somehow the private equity fund managers overestimate the value of their companies, and obviously some do, but on average that's not been the finding today.
Thank you. Yeah, we had a talk about that during the program last time. Could you answer another question for us? This one's been sent over from Rohit Rao, who has asked, how are you able to exclude the effect of grouping funds into families for this analysis?
Well, we form the sequences by fund family. Okay, so that we essentially that's how we sort of track when a team does a new course. So we've got to do that. Now it does create, of course, some statistical issues that you might say that there could be some sort of similarities in the types of deals that they do, for example. You know, that maybe one fund family does a deal, only does deals in the utility space or something like that. Now, of course, we can control for some of those things where we know the industry that they invest in. We know the years that they did their deals, so we can control for years. And we can also actually statistically deal with some of the issues by what we call cluster and standard errors at the level of the fund family, so that we deal with any sort of increased randomness that is associated with the fund family. So we can deal with that in various ways. I'm not exactly sure whether I've answered that question, but I think it's natural to do it at the fund family level, but it does bring in certain issues that you do have to address.
Okay, just a couple more questions, and then we'll wrap up. So, given the data which we've been looking at, would you say that differences in GP performance over time are statistically significant?
Well, I would say that this paper wasn't looking at GP performance per se, it was looking at how it evolves over time. But there's no doubt that the performance of GPs is very different. As you can see by the fact that the difference between the top quartile deals and the bottom quartile deals was a factor of 10 or something like that. So we know that there is a big variability in returns of the sort that you don't see in a lot of other asset classes. However, the question, if you like, interpreting the question again, I would say, if it's saying, are there certain GPs which have persistently, statistically significantly different performance over time, I would be surprised if that were not the case. Because I think that what we're talking about here are sort of broader issues about performance of the asset class as a whole and the fact that it's become more mean reverting. But you do still see some, there are some GPs who do particularly badly or particularly well. And there are certainly some GPs who, on the evidence that we've seen, would be statistically, above average or below average. And so it's not just a sort of cloud of data where, you can't really see the wheat from the chaff. I mean, you can see some performance which is better or worse over time. But it does depend upon over what timescale you look. Because one of the implications of this research is, the longer you look at a GP, the less exceptional they become. Because there is mean reversion. So, no doubt, at a deal-by-deal level, definitely differences. At the fund-by-fund, certainly differences. But as you look over a fund family, those differences become less statistically significant.
And I guess the final question too, just to wrap up on that and to build on that, is given that performance persistence is going down, what clues does this data give us about how people should perhaps select future funds?
Yeah, well, that's the million-dollar question, isn't it? And that really requires, I think, a bit more analysis of, what factors were important in determining the success of a particular set of deals. In other words, if I was an LP thinking about looking to invest in private equity funds, I would ask for this type of data. I'd want to see how variable they are, how much of their performance is associated with particular deals. In other words, how concentrated are the returns? Was a particular member of staff associated with most of the good deals, and is that member of staff about to retire or still in the next fund, and all that sort of thing. And in fact, we've got follow-on projects which are trying to answer that question a little bit more directly. Whether there's any evidence in, say, the distribution of returns within the set of deals done by the GP. So, for example, is it a good thing if the returns are sort of are good on average without ever having too many exceptional ones, or if they are very dispersed with some exceptional deals and they lose a lot of deals as well? Is that more instructive? Is that a good sign or a bad sign? But that again is one of those questions which is absolutely valid, but it's one of the things is aimed for another day when we've done more analysis of this data. But will probably also require additional data of the type I put on this slide. In other words, who are the professionals involved? Some databases are starting to track this in what looks like a more useful way. And so this is one of those, we're still in the very early days of private equity research, and that will be one of the questions which people like me will be looking at over the next few years.
Great. Fantastic. Thank you very much, Tim. That's very clear and wonderful answer. So thank you very much. I know you've got a very busy schedule, a busy afternoon, so thank you very much for your time with us today. I think that's all the questions that we have time for at the moment. To recap then for a couple of minutes before we close for today, I want to remind you that obviously we are in this webinar for a number of reasons. So it's good to see, first of all, a few alumni from the executive program and also from our MBA on the list today, and also a good international selection on there. So it's good to share our latest findings from the Private Equity Institute. Also wanted to keep in mind that we have this year's executive education program coming up in June. So the dates for that are in front of you now. So that runs the 29th of June to the 2nd of July. And that follows a format of 3.5 to 4 days, very full days, where we will cover really the whole value chain of private equity. So really starting from an introduction into some of the LP or institutional investor questions, to how much of an overall portfolio it might be sensible to allocate to private equity, why, and some of the pros and cons of that. We look at some case studies, including one from the University Endowment Management, where we'll hear directly from the investment director there. We then kind of move on, I guess, the next stage to look a little bit about some of the information we've looked at today. So private equity fund performance, how that's measured. Start to think about how institutional investors can select future funds. We look at some of the economics around that, some performance measurements, and then start to look more at the GP or private equity firm side in terms of leverage finance, how they build deals, how they model some of their valuations. We spend some time looking at venture capital, and then a hot area at the moment really around emerging markets with the explosion of growth really in private equity structures throughout the world, but I guess particularly in Africa and Asia at the moment, before closing on Thursday by looking at exit routes and really delving deeper into some of the other data and research that comes out of the Institute to think about what the future might hold. So this is a program which runs in the end of June, so we're about 3 months away. We are looking for a group of about 40 people. We have about 25 of those signed up at the moment, so we do have some space left, but we do have a good group coming in already. The type of people who come on the program are typically already experienced in relatively senior, either in finance or in corporate management. So they come from across the whole sector. So you'll see on the slide in front of you the list of the types of organisations which people come from. But I guess the pie chart kind of tells the story of from the private equity sector where people are coming from. So that's roughly breaks down into quarters between general partners, so people working at private equity firms. So sometimes these are people who are setting up their own PE fund. Sometimes they're moving in from another sector. Another quarter will be people from the institutional investors. So sometimes they are deal makers, sometimes they're more back office, due diligence staff, and so on. A growing area, actually, over the last couple of years has been people coming from corporates. So these will typically be directors in a finance or a business development type role, which are doing a lot of acquisitions, maybe kind of running an internal private equity type fund. About 15% from banks and 10% from various advisors, consultants, service providers. So if that sounds like a good group for you to be with, I think you'll see that that's going to be already a fairly well-educated group, and then that'll be a good opportunity to share your experience and questions with your colleagues in that group, as well as with the other faculty involved and the guest speakers. So thank you again for your time in attending this webinar today. We will send you an email out to make it easy to get back into contact with us. If you'd like to ask any questions regarding the program at all, then my email address is on the slide in front of you now, so steve.brewster@sds. So please feel free to send any questions in, or of course visit our website at sds.oxford.edu/PE, where you've got to read much more about the program, some links to some further information, and some videos. So thank you once again for attending. Thank you, Jenkinson, for your time, and we hope to see you in Oxford soon. Thank you. Bye-bye.